Dear clients, welcome to PhillipCapital's Weekly Market Watch. I'm Chen, Macro Analyst from Phillip Securities Research. Today I'm going to share with you the China macro and equity strategy. China's economy is showing signs of bottoming out, with most of the recent economic statistics for September and October showing improvement. Growth of fixed asset investment, retail sales, industrial production for September all reported accelerations compared to the readings in prior months, and also beating the market expectations. Official manufacturing PMI for October returned to above 50, indicating a slight expansion. This is further backed by the improvement of HSBC manufacturing PMI, which mainly focus on small and medium enterprises. October official non-manufacturing PMI rose to 55.5 from earlier 53.7, indicating a faster expansion in the service sector. Though HSBC service PMI dropped slightly to 53.5, indicating a slightly slower pace. Although the headline GDP growth slowed down to 7.4% year-on-year in the third quarter, slower than the 7.6% year-on-year reading for the second quarter. On quarter-on-quarter basis, the GDP has actually accelerated for a second consecutive quarter, adding to our conclusions of bottoming out. The earlier announced over 1 trillion RMB infrastructure investment will keep lending support to China's recovery going forward, and we are forecasting a 7.8% GDP expansion with an inflation of 2.5% in 2012. Export sector remains weak, with 3 months rolling export growth to US and European Union, both trending downward. There's yet no sign that the earlier announced open-ended QE3 by Fed and the potential execution of outright monetary transaction by ECB have triggered the bull run in the global demand. In addition, the approaching US fiscal cliff is an added risk in the near term for China's export outlook. Export to ASEAN countries is robust, but the stabilizing effect would be limited considering the smaller size compared to those of US and the European Union. Housing price and inflation, two of the government's main considerations for giving out further monetary loosening, remain tame. July, August, and September data for housing market showed that through the past 3 months, there was an increasing number of cities seeing month-on-month price decreases, and fewer cities are seeing month-on-month price increases. Moreover, over the 1-year horizon, most of the 70 major cities are seeing decreasing housing price. Inflation reported 1.9% in September, slightly slower than the 2.0% in August. Producer Price Index reported 3.6% year-on-year drop in September, which would help mitigate the inflation pressure. The recent announced QE3 by Fed would export inflation to China going forward. However, the effect would likely be limited within 2012. Given the tame property price and inflation, the Chinese government does have scope for further monetary loosening. A further 50 basis point cut in reserve requirement ratio is probable within the remaining time in 2012. For the equity market, we are seeing attractive valuations in both H-share HSCEI index and A-share CSI 300 index, whose PE ratios are currently at or close to their historical low. Therefore, for investors with a long-term horizon, we have been recommending that it's a good time to enter the China market. As for clients with shorter-term horizon, we are also changing our China market rating from the previous market weight to overweight due to the recent better-than-expected macro data. We are of the view that the market would gradually regain confidence and a rally is likely on its way. In fact, as shown in the charts, the earlier downward trend was already broken, and the H-share HSCEI index was trended up since September, though the rally in A-share CSI 300 index is only in a nascent form. As we hold a positive view for the short term and expect the sentiment discrepancy between H and A-share market to correct, we favor the A-share CSI 300 index slightly more due to the potential to catch up, though we are simply positive on both H and A shares on an absolutely basis. We encourage our clients to read our monthly China strategy report for more details on our asset strategy. as well as the wide array of ETFs and CFDs available that clients can tap on to trade the market outlook with. That's all that we have for you today. Do stay tuned to the next week's video on the third installment of our macroeconomic outlook. Thank you.